Hi, Happy New Year 2023.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager.
Today is January 2nd, 2023, and this is my 2023 forecast for this coming year. So 2022 was a bad year for the market, and I'll be reading off of a script that you see there. And analysts were reacting to the interest rate hikes by the Fed. There was the COVID-19 scare at the beginning of the year with Omicron, and then of course the Ukraine incident in the early part of the year. And that kind of resulted in the stock market pulling back, and it pulled back approximately 20% for the year. Now what's interesting is year over year, 70% of the S&P 500 companies, the market in other words, beat expected earnings by in 2022. Interestingly enough as well is the PE ratio of 17.3 remained above the 10-year average, which was 17.1, and that represents strong and steady earnings for the corporations. Yet despite this, many analysts were predicting that these earnings would fall off for the year, and they didn't. They didn't fall off. They pulled back a little bit of a slowdown, but they didn't really significantly fall off. Again, 70% beat earnings expectations. Now there's talk of a recession in 2023, and let me address that. First off, I do not believe in 2023 that we will be going into a recession, and the main reason is the jobs number. The jobs number is the highest it's been since 1969 in our country. So in order to move into recession, you really need you need more unemployment. It's what you need in order to have a recession. So it's pretty hard to say, hey, we're going into recession when the jobs market is just so strong in the United States. And that's my main premise for believing that we're not going into recession in 2023. Also, I see no major shortages of commodities. Typically when you're in a recession, there's always a shortage of something. I don't see a shortage of energy. I don't see a shortage of metals, wheat, anything like that. So I don't really see any of these major indicators of shortages for us to move the country into recession. However, to address the issue, many of you ask, if we do have a mild recession, I've gotten many questions like this, what is the average length of time that a recession lasts? It's funny, but it's only 10 months. Yep, it's only 10 months before you see a recovery from an economic rebound from our country if a recession was to occur. And again, if we do have one, it has to be very mild, simply because the jobs number is so strong in the United States. And that's kind of what's been miffing everybody, the analyst, is that they say, hey, we're going into recession, hey, we're going to have bad earnings reports, and we don't. And so that's why you see in like July and October the market pulls back, and then it rallies back up during the earnings report because the companies are beating earnings expectations. Now let's talk about a slowing economy. Are we going to have, and are we having a slowing economy? The answer is yes, we are, but that's by design. So when there's a strong overheated economy, the Fed raises interest rates to slow down the economy. And the first area to slow down is housing. And so that's by design. The Fed does that to get inflation under control. And so he does that by raising interest rates. So this is all normal. And it doesn't mean that we're moving into a catastrophic situation in the economy. not by any stretch of the imagination. And it's very important to remember that a slowdown in the economy does not mean that we're going into a recession. That's not what it means. It just means that we're letting off on the gas. If you're going from point A to point B in a car and you're letting off on the gas a little bit, you're just slowing it down. It simply means the speed of growth in the economy. Now, what industry sectors are expected to expand in 2023? In 2023, there are three major areas, sectors that are industrial sectors that are expected to expand, and that's the energy sector. And now with China opening up, I mean, they're our biggest importers of oil, and so I suspect that that they'll be using more energy again, and maybe not as much as they did before, but again, they are one of our biggest importers of energy, and they just opened up for this year. The other area is the industrial sector. So we're seeing an expansion in more industrial products that are being sold worldwide, and so we see an expansion of the industrial sector. And the last sector, believe it or not, is the real estate sector. Now, it's funny, what I'm talking about is that the value of real estate. So when you're in an inflationary environment and inflation's moving up, the value of real estate moves up. That's right, the value of real estate moves up. I'm not necessarily talking about home sales. I'm not talking about that. I'm talking about the value of property. And so that's expected to expand in 2023. What are some areas that we see a slowdown in? I mean, you could see a slowdown in the healthcare sector and perhaps in the communication sector. So typically recessions, do hurt the communication sector and healthcare. Now the financial sectors remains to be seen, because normally rising interest rates helps banks. In other words, they're able to charge more on their loans and things like that. But also at the same time, if you have a slowdown, and then maybe they're not producing as many loans, so that on the other hand, that could be a slowdown in the financial sector. But that still remains to be seen. So we're going to keep our eyes open about that. Now, as far as historical rebounds in the market, so we just came off of a very bad year. What historically has been the rebound in the following year after a double-digit negative return for the market? Historically speaking, the average return on the rebound has been 14% per year in the following year. So we'll see if that sticks. Now, do I see any major or catastrophic bad news on the horizon for the United States economy? The answer is no, I don't. There's no major economic factors causing the economy to, collapse or pull back or anything like that. Again, as a matter of fact, I said, China's opening up, and many other countries around the world are still opening up from the COVID-19 pandemic. So they're still starting to expand. And also, furthermore, if you look at our vacation travelers are continue to travel. If you look at the airports are full. I mean, it's just incredible how much travel that is occurring. As a matter of fact, it's funny, but the cruise ships, which shut down during the 2020 pandemic, they have in fact removed any discounts. So they used to be offering discounts to encourage people to go cruising again right after the pandemic. Well, now they have removed those discounts. Most of the cruise ships have removed not only discounts from their fares, but discounts from offering free casino trips and things like that. And the reason is the cruise ships are at full capacity. So it's like they don't need our discounts anymore, or to offer these discounts, because they're running at full capacity. It's almost like, they did away with the mask requirement, and everybody said, hey, I need to go on a cruise ship. And it is the best bang for your buck in terms of you get food, you get room and board, you get to see destinations. And many of the cruise ships themselves are, they have water slides and things like that. So they are, quite entertaining just to go on a cruise. So do I believe that the market is going to rebound for this year? I do. I do believe that. And again, I've been in the business a long time, and when the Fed is raising interest rates, the market goes up. Now, it hadn't happened in 2022, but over time, when the Fed is raising interest rates, it does indicate that the market is expanding, the economy is expanding, and typically the stock market goes up. Likewise, on the other side, conversely, if the Fed is lowering interest rates, then that means the economy is in trouble. And so what they do is they lower interest rates to jumpstart the economy, to offer lower loans or more loans, to offer more money to jumpstart the economy. And then the stock market typically follows and it pulls back. Now here at Cantu Tactical, when we see the Fed lowering interest rates, we typically move into fixed income bonds and things like that. But with the Fed raising interest rates, we want to remain equity heavy. Again, when the Fed is raising interest rates, typically the market goes up. Historically, it does. Anyway, that concludes my forecast for 2023. So anyway, stay safe.
Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager. Over 10 years ago, he created Cantu Tactical Wealth Management, which actively balances and selects investments based on a tactical approach rather than the traditional strategic management method. Instead of the buy and hold philosophy, he believes in the pursuit of finding investments showing momentum, performance regardless of the direction of the market. His experience includes IRA accounts, 401k rollovers, trusts, endowments, defined benefit plans, 403bs, and 401k plans. Additionally, he served as a night college instructor for seniors, teaching high net worth retirement and estate planning for 14 years. Podcast views and personal opinions are for educational and entertainment purposes only and does not constitute a recommendation. Investing has risk of loss and you should consult with your own advisors for any financial decisions. Cantu Tactical Wealth Management and Joe Cantu are a fiduciary firm and registered investment advisor in the states of California, Florida, Georgia, and Texas, providing pure independent advice and money management.